The stock market is a captivating arena. It holds the promise of wealth and financial freedom. A surge in the stock market is like a rising tide. It lifts all boats. Investors dream of these surges. They represent opportunities for significant gains. In 2025, will the market surge? This is the question on everyone's mind. Economists, analysts, and investors are all searching for clues. The answer, however, remains elusive. Predicting the market is a complex endeavor. Despite the uncertainty, we can analyze the factors at play. By examining economic trends and market indicators, we can gain insights. These insights can guide our investment decisions. Let's delve into the world of economic forecasts and market analysis. Our journey begins with a global perspective. The global economy is interconnected. What happens in one part of the world affects the rest. To understand the potential for a stock market surge in 2025, we must consider the global economic outlook. The International Monetary Fund projects global growth of 3.3% in 2025. This suggests a stable but slow economic environment. Morgan Stanley, a leading financial institution, forecasts a slightly lower growth of 3%. They cite rising uncertainty and policy changes in the United States as contributing factors. Inflation is another critical economic indicator. The IMF anticipates global inflation to decline to 4.5% in 2025. This moderating inflationary environment could positively influence market sentiment. Lower inflation erodes the value of money less quickly, making investments more attractive. The United States and the Euro area are major players in the global economy. Their performance will significantly impact the stock market. Goldman Sachs, a prominent investment bank, projects U.S. GDP growth of 2.5% in 2025. This exceeds consensus estimates and suggests a robust U.S. economy. However, Morgan Stanley anticipates a slowdown in the U.S. economy due to potential policy changes. For the Euro area, Goldman Sachs forecasts a 0.8% growth in 2025. This lags behind consensus estimates, indicating a potentially sluggish Eurozone economy. The divergence in economic forecasts highlights the uncertainty surrounding the global economic outlook. Predicting the stock market is notoriously difficult. It's like trying to predict the weather months in advance. However, market analysts and financial institutions use sophisticated models and historical data to make educated guesses. One widely followed index is the S&P 500. It tracks the performance of 500 large companies listed on stock exchanges in the United States. Goldman Sachs predicts the S&P 500 to reach 6,500 by the end of 2025. This represents a 10% total return, including dividends. Oppenheimer Asset Management, another investment firm, sets a higher target of 7,100 for the S&P 500. Meanwhile, UBS forecasts 6,400. These varying predictions highlight the uncertainty surrounding market performance. Even the experts don't always agree. Forbes, a leading business magazine, describes the prevailing outlook for 2025 as cautious optimism. Factors such as technological innovation and lower interest rates support market growth. However, high valuations and global tensions pose risks. International markets also present opportunities and challenges. Charles Schwab, a brokerage firm, suggests that international markets may offer solid returns in 2025. However, challenges like uncertain trade policies and slower economic growth persist. Section 4. The force field factors influencing the market. The stock market is a complex ecosystem influenced by numerous factors. Understanding these factors is crucial for making informed investment decisions. Let's examine some of the key forces at play. Interest rates are a significant driver of market performance. Lower interest rates make it cheaper for companies to borrow money. This can lead to increased investment and economic growth, which in turn can boost stock prices. Conversely, higher interest rates can dampen economic activity and weigh on the market. Technological innovation is another powerful force. Advancements in artificial intelligence, cloud computing, and other cutting-edge technologies create new industries and investment opportunities. Companies at the forefront of innovation often see their stock prices soar. Geopolitical risks can inject volatility into the market. Trade wars, political instability, and military conflicts can disrupt global trade and create uncertainty. Investors tend to be risk-averse, so geopolitical tensions can trigger market sell-offs. Fiscal policy, which encompasses government spending and taxation, also plays a role. Expansionary fiscal policy, such as increased government spending or tax cuts, can stimulate economic growth. However, excessive government spending can lead to inflation and higher interest rates. Market valuations are another important consideration. When stock prices are high relative to company earnings, it suggests that the market may be overvalued. Overvalued markets are more susceptible to corrections, which are sharp declines in stock prices. Conversely, undervalued markets may present buying opportunities. Section 5. Navigating the Market Maze Investment Strategies. Investing in the stock market can be daunting, especially given its unpredictable nature. However, there are strategies to help mitigate risk and increase the probability of success. Diversification is a fundamental investment principle. It involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. Diversification helps reduce the impact of any single investment performing poorly. Risk management is another crucial aspect of investing. It involves assessing your risk tolerance, which is the amount of potential loss you are comfortable with. Factors such as your investment time frame and financial goals should influence your risk tolerance. Staying informed is paramount in the ever-changing world of finance. Keep up to date with market news, economic trends, and company-specific information. Numerous online resources, financial publications, and investment professionals can provide valuable insights. Section 6. Weighing the odds, a balanced perspective. The question of whether the stock market will surge in 2025 remains unanswered. Economic forecasts and market predictions provide valuable insights, but they are not guarantees. The market is inherently unpredictable. There are both potential gains and risks to consider. On the one hand, factors such as technological innovation, lower interest rates, and a recovering global economy could propel the market higher. On the other hand, high valuations, geopolitical uncertainties, and potential policy changes pose downside risks. A balanced perspective is essential. Don't let greed cloud your judgment during bull markets, and don't panic during bear markets. Stick to your investment strategy, stay informed, and be prepared for volatility. Section 7. Charting your course, the importance of research. As we've explored, numerous factors influence the stock market's trajectory. Predicting its course with certainty is impossible. However, by understanding economic trends, market indicators, and investment strategies, you can make more informed decisions. Before investing, conduct thorough research. Consider your financial goals, risk tolerance, and investment time frame. Consult with a financial advisor if needed. They can provide personalized guidance based on your specific circumstances. Remember, investing involves risk. Past performance is not indicative of future results. However, by approaching the market with knowledge and a well-defined strategy, you can increase your chances of success.